Hi, my name is Luke Siciliano. I'm a web developer. I'm also self-employed. I've done a video before for freeCodeCamp on the topic of whether or not you should go the freelance or self-employment route after you're done learning how to code. We're going to link to that video in the description below. Now, assuming that you've decided, hey, I think I want to be a freelancer, I think I want to start my own company, I think I want to work for myself, rock on, good for you. I think you should go for it. I think you're going to find the experience incredibly rewarding, both financially and personally. With that being said, there are a lot of things that come along with running your own business that can cause a lot of people to feel intimidated. And that's due to the fact that when you're working for yourself, you have to deal with a lot of things that in the past an employer handled for you. Things such as, how do I deal with health insurance vendors? Because when you've got a job, you just sign up for the plan the employer gives you. Well, now you've got to figure out where to get health insurance from. Things such as, how do I pick a provider for my retirement account? Because again, when you're employed, your employer just says, here's who we go through. You're going to go through Vanguard, Fidelity, whatever, and you just sign up for their plan. Of the things you have to start dealing with when you're self-employed, perhaps the issue that intimidates entrepreneurs more than anything else is the topic of taxes. People might be concerned about how much am I going to be taxed on? How do I pay my taxes during the course of the year? How do I get money to the government? So on and so forth. I am here to tell you that the issue of taxes, which we're going to break down in all this in a second, is not something that you need to be intimidated over, and you certainly don't need to let it intimidate you to the point that you decide not to start your own company, okay? You've just learned how to code. You can learn how to deal with these kinds of issues. So just understand, working for yourself means continuous learning. You're going to learn how to deal with issues and you're going to be successful, all right? So do not let these kinds of issues, especially taxes, intimidate you out of working for yourself. So in this video, what I'm going to do is talk about three things. Number one, I'm going to talk about what it is you actually are responsible to pay taxes on, what's your income when you're self-employed. I'm going to talk about how you can structure your business to manage your tax obligations, and then I'm going to provide some kind of basics that we do in our business, to help streamline some of these issues. One thing I'm going to really stress before I get into this is the fact that I am not a licensed tax professional. I am not holding myself out as one. I am not holding myself as any kind of a financial advisor. These are things you really need to talk to a lawyer about, talk to a tax accountant about, so on and so forth, to figure out what's best for your particular situation. What I'm doing in this video is sharing my knowledge with you and explaining to you what we do in our business. So with that being said, let's look at what it is you actually pay taxes on. In other words, what's your income when you're self-employed? A lot of people make the mistake of thinking that everything that comes into the business is their income. So in other words, person one writes you a check to build a website, person two pays you cash, I should say, to build an app. Person number three pays you in a credit card to build some local software that they want to run. All those things come into your business. That is not your income, that's your revenue. Everything that comes into the business that anyone pays you is what's called your revenue. So your revenue is everything that comes in. You have expenses, which are everything you pay out to run the business. Maybe you had to write a check to Amazon Web Services. Maybe you had to rent an office. Maybe you had to pay the utilities at that office. That's the money you spent to make money. So everything that comes in is your revenue, minus everything that goes out is your expenses. And after that, you get what's called your net income, okay? So under our little scenario here, let's say during the course of a year, you brought in $120,000 in revenue, $10,000 a month. Again, building websites, building apps, whatever. During the course of the year, your business paid out $20,000. You had to rent an office, you paid Amazon Web Services, you had to pay utilities at the office, things of that nature. So you brought in $120,000 in revenue, you paid out $20,000 in expenses. That leaves you net income of $100,000. So at the end of the year, when you're reporting your income to the IRS, this is the number you report as income, $100,000. And this is the amount that you will be taxed on. So depending how you structure things, a certain percentage of this is what you're going to pay to the government. You are not going to pay a percentage of your revenue. You're going to pay a percentage of your net income, generally speaking. Okay? Now, how much of this $100,000 you pay to the government, and how you pay it to the government during the course of the year will depend on how you structure your business. So now let's take a look at 3 ways that you can structure your business. There's a lot more than this, but for the purposes of this video, I'm gonna go over the 3 that, if I had to guess, are the most common for freelancers, small entrepreneurs, things of that nature. One is a sole proprietorship. I've got Sole P for that. One is an LLC, which is a limited liability company. And the third is to choose to tax yourself as an S corporation or an S Corp. I'm going to talk about each of these in turn. Sole proprietorship means you don't go out and start a separate business. In other words, you're doing this as an individual. You don't go out and start an entity. You don't go start a company. So in other words, instead of starting an LLC or an S corporation, I just go out and get a business license and I start building websites and doing these things for people individually, and then they write a check, directly to me, and then that all goes into my revenue. So that's a sole proprietorship. It's not a separate entity. You're just handling things directly. And at the end of the year, if you're a sole proprietor, you're going to attach what's called a Schedule C to your tax return, and that Schedule C will report your income or your revenue, your expenses, and the $100,000 in income. And what this person will want to do, since they're not getting a paycheck, they're self-employed, is every quarter they're going to send some money in to the IRS, and then that's going to be the same as having, or in lieu of, I should say, having withholdings from a paycheck. And then you make those estimated quarterly tax payments to make sure at the end of the year you don't get hit with a huge tax obligation because of the fact that you have income from that. So sole proprietor, again, just to be a little repetitive, not a separate entity, just an individual, essentially an individual with a business license. Money comes into the business, or I should say into them personally. Every quarter they send an estimated tax payment into the IRS. At the end of the year, they report their income on their Schedule C on their personal tax return. If their estimated tax payments cover their obligations and they don't owe anything else, if they overpaid their tax obligations, they'll get a little bit of a refund. If they underpaid, they have to write the IRS a check. That's how a sole proprietor works. Another option is an LLC. This stands for limited liability company. As opposed to a sole proprietorship, this is an actual separate entity. You have started a separate entity, a separate business. And what happens is you start the LLC gets a business license. All this revenue comes into the LLC in a bank account in the LLC's name. All these expenses get paid out of the bank account that's in the LLC's name. At the end of the day, the money that's left over gets distributed to the owners. The owners write themselves a check, they call it a distribution, and that's how they get their money from the business. The LLC does not pay any taxes, okay? At the end of the year, the owner is going to get what's called a K-1. It's a tax form. The owner is going to get a K-1 from the LLC saying, LLC had $120,000 in revenue, LLC had $20,000 in expenses, LLC profits are $100,000. The individual owner will pay taxes on the $100,000 on their personal tax return. Same as with a sole proprietorship. If you're going the LLC route, what you want to do is send in quarterly tax payments to the IRS, so at the end of the year you don't just have to write a huge check for your taxes, and it also helps you avoid getting hit with any penalties. So that's an LLC. The third thing you can do is choose to be taxed as an S Corp. This is what we've done in our business. Now, an S Corp is another form of a company, but what we've done is we have started an LLC, and there's a form you can file with the IRS, linked to in the comment form below, where you are telling the IRS that we have an LLC. For tax purposes, please consider us an S Corp. So in other words, for all legal purposes, we're an LLC, but as far as the IRS is concerned, we're an S corporation. An S corporation works a little different. Do you remember with these, I was talking about how you just distribute money to yourself as the owner? Well, with an S Corp, if you're owning the business, you're also an employee of the business. So you set up payroll just as you would for any employee. You're required to pay yourself what's called a reasonable salary, and then any profits on top of the salary you distribute to yourself. So in other words, let's say, after expenses, company brings in $100,000. let's say an average reasonable salary for a web developer in my area is $60,000. So, I run payroll just like I would with any other employee, and I pay myself a salary of $60,000 because I'm required to pay a reasonable salary to myself. Taxes get withheld out of my paycheck just like they would for any other employee. And then after that $60,000 salary, I've got $40,000 in profits left over because 100 minus 60 is 40. I take that $40,000 as a distribution. So just like here and here, total I'm getting $100,000. It's just that here you got distributed $100,000 directly, here you got distributed $100,000 directly, here you got $60,000 in salary and a $40,000 distribution. Now, again, this is what we do in our business, and I know hearing what I just said, this probably sounds way more complicated than these. So you're probably wondering, why would you want to own the business and be an employee of the business and deal with payroll and give yourself more headaches? Okay, and I understand why people feel that way. Here's why you do that. When you get a paycheck from an employer, you are used to federal income tax being held out. You also see Social Security, Medicare, Medicaid, FICA, those kinds of things being held out of there. Let's call those things employment taxes. Social Security, Medicare, Medicaid, those are your employment taxes. Well, when you work for yourself, because you're not getting a paycheck, no one's withholding anything from your paycheck. So I talked about with these, you're going to send estimated quarterly payments to the IRS. But those estimated quarterly payments only apply to your federal income taxes. They don't apply to Social Security, Medicare, Medicaid, FICA, employment taxes, which is what we're calling them. So at the end of the year, you're going to have to pay what's called a self-employment tax on top of your federal income tax. And your self-employment tax is the equivalent of those employment taxes, Social Security, Medicare, Medicaid, so on and so forth. So, sole proprietor in an LLC, if you make $100,000, on top of your federal income tax, you're going to pay employment tax or self-employment tax on the $100,000, which is about 6.2%. So in other words, after these people have paid their federal income taxes, they're going to pay another 6.2%, or in this case, $6,200 to the government on top of their federal income taxes to make up for the fact that they didn't pay in the Social Security, Medicare, Medicaid during the year. They're going to pay self-employment tax. So that's $6,200 on $100,000. Now let's go down to my scenario again that I gave down here. Excuse me. Remember I said you're an employee of the business and you also own the business? Well, when you're an employee and you get a paycheck, that means federal income tax gets held out, Social Security, Medicare, Medicaid gets held out. So that Social Security, Medicare, Medicaid is 6.2%, the same as the employment tax that these people pay. So on that $60,000 salary, again, we said you're getting a $60,000 salary and a $40,000 distribution out of the 100. On that $60,000 salary, you'll pay the 6.2% employment tax. The thing about an S Corp is that that $40,000 distribution that we got on top of our $60,000 salary, you pay federal income tax on the $40,000. But that $40,000 distribution, in other words, anything beyond your salary, is not subject to the self-employment tax. So in other words, you do not pay the 6.2% self-employment tax on that 40% profit, okay? Or $40,000, I should say, profit, which under our hypothetical right here would save you, call it $2,500. 6.2% of that $40,000 profit is roughly $2,500. So in other words, the sole proprietor pays 6.2% employment tax on their entire $100,000 plus federal income tax on the $100,000. The LLC pays 6.2% employment tax and federal income tax on the $100,000. The S Corp owner pays federal income tax on the full $100,000 because they took $60,000 salary and they've got $40,000 profit. They pay, which is $100,000. They pay federal income tax on all that, but they only pay the employment tax on the salary portion, and the profit does not get hit with that 6.2% tax. So if you were to add up all the obligations at the end of the day, this person's going to pay a little bit less in taxes than these people. So there are some tax advantages to doing an S Corp, which is why you're going to go through the extra rigmarole that I talked about a minute ago of setting yourself up as an employee, so on and so forth. Now, a couple of things about this is you have to pay yourself a reasonable salary. You can't pay yourself $5 or something like that. You have to pay yourself a reasonable salary. Talk to an accountant, talk to your CPA about what is a reasonable salary for you to be paying yourself. That's issue number one. Issue number two is that there's some complications that come along with an S Corp in the sense that, yes, you have to pay yourself a salary and manage all that. Don't make that complicated. Sign up for a payroll service to manage that for you. We use Intuit payroll services in our business. There's a lot of different payroll services like ADP and whatnot. They will, if you sign up for their full service options, they will manage the withholdings for you. They will file your different state and local forms for you, so on and so forth, so you're not buried in paperwork all the time. So while setting yourself up as an employee may sound complicated, using a service, a payroll service to manage that for you actually makes it pretty simple. I mean, again, we use Intuit Merchant Services. I would say at the end of the day, it's actually pretty seamless having ourselves set up as employees of the company, and we save money in taxes at the end of the year, because of it. So again, what we do in our business is an LLC with an S Corp election. That's what we do in our business, but what's best for your particular situation is something that you need to talk to a lawyer or an accountant about. One last thing I want to close on with this is the topic of your expenses. One mistake I see a lot of entrepreneurs making is they run the risk of underreporting their expenses. There are a lot of things that are expenses for your business that you might not realize. If you leave your office to drive to a business meeting, your mileage might be an expense. If you go out to a business dinner with other developers and for work purposes, it's possible that the cost of the meal might be a business expense. There are lots of things. If you have to buy a computer for the office, that might be a business expense. There are lots of things that are business expenses that people say, hey, I'm not sure if this is an expense or not. Well, at the end of the year, what those people do is they might have a stack of things that they're not sure if they're expenses, so they don't give them to the accountant. Well, if the accountant doesn't know about those expenditures, they're certainly never going to be counted as expenses on your tax return, right? So what I would suggest doing is save everything. You've got to document your expenses. You can't just say my expenses are X. You have to have documentation of them. Save all your receipts, document everything. Err on the side, when you're talking about your expenses, err on the side of saying something is an expense. And at the end of the year, give everything to your accountant and have your accountant tell you whether or not something is an expense. Don't make the mistake of thinking, I'll just assume this is not an expense. Assume it might be and ask your accountant, okay? Because you want to capture all those expenses that you possibly can. Because again, if your revenue is 120 and your expenses are 20, you pay taxes on $100,000. Well, let's say under this scenario, there were $10,000 in things in potential expenses that you missed and you didn't give to your accountant. So that means you brought in 120, you only expense 10, so you pay taxes on $110,000. In other words, your tax bill is bigger. Record everything, give it to your accountant, and let your accountant tell you whether or not something is an expense. I'm not saying to just put everything on your tax return as an expense. I'm saying ask your accountant about it. That's the one last piece of advice I will give. Now, we all know there was a big tax change recently, and that the tax code is different for 2018. Prior to doing this video, I have talked to the CPA that does our taxes, and he has, what he told me, and again, this is not advice to you at all. What he told me is that this is still the way to go. He is advising us to continue to go this way that I've just talked about with our taxes, even after the change in the recent changes, I should say, in the tax code. So If you have any questions, feel free to contact me directly. I know this may sound like a lot. Trust me, taxes are not something that should intimidate you out of running your business. Okay, they're just not. Get a good CPA, talk to a lawyer, structure your business the right way so you pay as little as tax as necessary. Make sure you record all your expenses, and hey, you'll be fine. This is what we have CPAs and lawyers and stuff for, right? So again, if you have any questions, contact me directly, and good luck in all your endeavors.